Hey Rishi, thanks for joining us today. Very honored to be with you and learn more about Kashable. I'm Matt Pierce, E4E Relief CEO. If you wanted to just introduce yourself for a minute and
Sure.
perhaps tell me a little bit about how and why Kashable started, I think we'd be off to the races.
Yeah, thank you, Matt. Thank you for having me. It's great to be on here. I'm Rishi, co-founder and co-CEO at Kashable. The Kashable sort of founding story is sort of grounded in my personal experience and that of my co-founder. We're both immigrants to the country, big believers in the American dream, have been fortunate enough to be effectively able to live it in so many different ways. But my first step in the country was as a scholarship student at MIT. That was my family had enough to kind of get me over, and but not much beyond that. And very soon, I was able to get a great job on Wall Street after and graduate from school and graduate into a fattish paycheck, let's say. But notwithstanding all that, I still quickly ran into sort of the stumbling block of not having credit history, and when looking for your first apartment lease in New York City and having to sign a guarantee and all that kind of stuff, it was quickly obvious that renting a car, getting a postpaid phone plan, there's a whole lot of everyday nuisances in life that are all kind of contingent on your credit score. And just like me, in my case, it was kind of quickly became obvious to me that there's a lot of people that are on the wrong side of that score divide, for no fault of their own and just by kind of force of circumstance. And in my case, that circumstance was immigration. But for many others, it's a whole lot of other things. So it could be something as simple as youth, because credit scores, the biggest component of them is length of credit history. You can't
Yeah,
accumulate length if you're not old enough. That's like us guys, Matt. But like,
yes, sir.
so we can have good scores, but what about the young college grad of any sort, like let alone me, right? It could be because of the neighborhood you live in. It could be the race you are. It could be a hundred other things. Like it could just be man versus woman. There's a whole lot of different things. There's structural kind of asymmetries in how uh, you know financial services are distributed or accessed in the country. So that was sort of one quick kind of realization for me, and the same thing for my co-founder, who was an immigrant from Israel, went to Columbia here, a similar experience. And we both felt that if we wanted to do something impactful in finance, and this was in the post financial crisis America, we could see that there's this big dichotomy that tech companies and big banks are all, by because of regulation or where venture dollars are flowing, they're all concentrated on this like top tier of the American social strata, which is sort of like the top 10 to 20% tops of, and that's a huge market. So it's plenty for them to focus on. But what about the other 80%? And who's going to solve for them? And that was the genesis of Cashable. Then how do we solve for that other 80%, that rank and file American worker that kind of is the backbone of both the country and the economy? And how do we do it in a way that where we don't lose our shirts? And sort of the paradigm we found, the construct where we can make it work, where the economics work for us and our end user, that employee, is by going through the employer channel. The finding That's a mechanism that's been used in health insurance, life, disability, a whole lot of other insurance type segments that are very similar to lending in many respects. And that there's a coupon that somebody's collecting for taking life event risk. And if group based underwriting, employer based distribution works for that, then our thesis was that it can also work in credit and delivering financial access. And it has. So we've been able to, by virtue of having HRIS system integrations for a lot of our underwriting data, and then payroll connectivity for repayments, which gives us much lower loss rates, and then employer outreach that gives us lower CACs, create a mousetrap where our unit economics are far more favorable than the average lender that's buying leads on Credit Karma or whatever else. And we can do this in a way where we win, the employer wins, and the employee wins.
Yeah. What an amazing product creation. As you're talking through that, I'm sitting here being like, what took so long for something like this to come into the market, right? And what's taken so long for something like this to get the momentum that I believe you all are starting to see. I think when I think about what we do and what you do, there's very good complement that comes into play.
Absolutely.
I think we have many employees, and a vast majority of 18 and up folks are employed, right? Whether or not they're employed by, a 100-person organization or a million plus, person employer, most of the world is employed, and most of the world is in that case. I talk a lot about here about the K-shaped economy, and I think that's going to
Right.
continue to build
Totally.
um, and compound. And so, how do we actually care for those 80% and help them stay productive in their community, stay productive at work, stay productive in their ability to be present at home? Like a lot of what happens in the world, it affects your household,
Yeah.
and you're not there for your household, you're not there for your community, you're not there for your job. Ultimately, the entire community construct suffers as a result of that. And so we've been big believers in that, for over 25 years, that relief, unexpected hardships, whether that's from a disaster or something outside your complete control, should not be a point of no return, right? It should be a point of safety. You should have an ability and a window to overcome and show back up after you've gotten, restabilized. And how you actually like think about what products exist when those type of events happen, right? Whether or not you have a medical issue come up and now you have $15,000 of medical debt, right? And we believe we're here to help, bridge the gap to get you back on your feet. We're not here, and we certainly don't expect employers or sponsors to cover that full
Yeah.
$15,000 debt. And that's
Yeah.
where I feel like you all come in really, really well. Is, hey, this is on you, the employee, to repay, but we're going to do this in a way that's not detrimental to you. This is in a way that's building you up as your credit score in terms of your ability to, perpetuate positivity, or positive lending, or savings, like overall financial well-being in the out years. So where do you all think Cashable fits, like overall in financial wellness and or like the benefit strategy of an employer
Yeah.
today
Totally.
and potentially in the future?
Yeah, very similar approach to what you're doing, almost exactly the same place. And I feel like in many ways, employers have had a more evolved benefit strategy in the same regard as it relates to employee physical health. For example, people do offer some sort of coaching style things, like they offer gym maybe subsidies or other things that are catered to you improving your physical health over time, but they also offer health insurance for that emergency when something does break and you need to have palliative care. And we see our role, your role at E4E in a similar way. Like when there is that, a lot of employers have historically adopted, as it relates to financial health, more of an education first strategy where they're saying, I'm going to help you become better. But that's similar to the gym in healthcare land, but you don't strip away health insurance. And in the same way, most people need to have an E4E, a cashable, alongside that, because that emergency will happen for a lot of people, whether it's natural disasters, it's the healthcare. In these days, it could be something as simple as a car breaking down, because one
Yeah.
car breakdown is $1,000 deal for most people, right? Like, so there's so many shocks happening in the system that we feel like this is the layer that we provide, that pragmatic safety net to get you through that emergency first, and then you can think about educating yourself and prepping better for the next one, right? And we cover the types of situations that your type of grant cannot. So whether it's because it's not a qualified event, but is an emergency nevertheless, right? Or it's because the grant is insufficient to cover the full extent of what the employee needs, because not all employers can afford to kind of grant away all the problems, right? So that's sort of where we fit in. Like it's providing that uh, pragmatic safety net with cash that we provide off of our balance sheet at no risk to the employer and no cost to the employer typically, to cover that gap.
When you are talking about your product to large organizations, employers, what's bubbling up to the top as like the top one or two most important outcomes they're looking to achieve by
Mm-hmm.
partnering with?
Yeah, typically when an employer comes to us, often, just like in your case, sometimes it could be the occurrence of a disaster, and then there's like an imminent need that brought you front of mind, right? Like this might have felt like a feel good action for a long time, and people were contemplating it, but something real often is like the impetus to implement, right? Like that moves people over the finish line, and often it's something similar for us, and it could be something like an employer seeing a lot of borrowing from their 401k plan, and they want to limit that. Maybe they allow people to take 2 or 3 loans from the plan at a time, and they want to curtail that to one. Or it could be something like a COVID happened. It could be something like 9% inflation happened, or could be that tariffs happened. Like they're seeing something that is impacting their population. It could be that they're switching to a high deductible health plan, something where they foresee that there will be challenge in their community, and that's the impetus. And then when that's the kind of impetus that they are seeing, then often that the metrics that they're looking for or in terms of success are similar. So we would provide things along the lines of, how much were we able to reduce borrowing in the 401k plan? Or how much were we able to improve retention, which is a common metric for all voluntary teams. And we have really been successful at all of it. So basically, in the large employers where we have had, for example, retirement plan data, one of our biggest clients, Huntington Ingalls, that came to our partner Alight, who is their record keeper. We did a long-term case study covering 3 years of 401k borrowing, and we were able to reduce by a third the amount of borrowing they have in their 401k plan. So we were also able to improve retention. So when we look at churn rates between cashable borrowers and non-borrowers, more than 30% better in the borrower population. So for any one voluntary benefit to have such a statistically significant kind of impact is very, very unusual. So there are those kinds of things that are very simple and easy for the employer to see in a categorical, numerical, analytical way. And then there are some other qualitative measures around financial stress and how much people are experiencing it, which are more around perception than around numbers. And those we evaluate by periodic surveys and being able to deliver those results to employers.
Yeah, that's outstanding. And I think it's, as you're talking about those metrics, I'm thinking about how we actually assess healthy employee bases, right?
Yeah.
And the magnitude of what's my, loan rate to balance contribution or whatever the case may be on retirement. Because this is also it's a decaying problem, right? If you're going to continue, you're investing today for your future tomorrow, and if you're taking away from that, it it's a rat race ultimately that you're going to not get yourself out of. And if you're going to go to a credit card or a cash advance, the rat race just gets even harder to get out of. So it's a really, really, really good solution. And I don't I wonder how many employers are actually looking at those metrics. Like, are those? Do you think those are normal metrics that are being looked at across the board? Do you think the larger employers are doing a better job at looking at those metrics? Like, where would you say the employer education or awareness to these KPIs or metrics is today?
Yeah, I think things like retention, there's a lot of employers that have been focused on for a long time, right? And impacting that is a very simple, like a good way for them to see your value. But things like borrowing from retirement plans and the cost of it in this long-term decay problem that you're talking about, that I think the HR circuit has not been as mindful of in the past. In fact, the common wisdom till a few years ago used to be to direct employees to 401ks to borrow from there, because it was like, oh, you're borrowing from yourself, you're only paying 6% interest or something like that. But without taking into consideration that almost none of those loans get paid back, and effectively it's a withdrawal with a tax penalty and loss of tax deferred growth, which is the whole point of a 401k plan. So like all of the benefits were getting depleted, and people weren't really thinking through this long-term financial consequence of these things. And a good part of what you and your team, us and our team, and some of our other peers in our industry, I think, have done a good job of in the last 10 years is elevating the profile of what is the value of financial wellness benefits overall, and what is the tangible benefit in dollar terms terms that they provide in cost savings on loans or in long-term wealth creation in your 401k plan or in your home equity or other places, that these types of benefits are allowing for this, like when you talk about I'm a big believer in this whole cave-shaped economy story, just like you are, and thinking about that bottom 80% of the country and how they're getting shut out of the home equity market, or they're getting shut out of wealth creation and 401k plans, at the same time when we have, the most number of 401k millionaires that the country has ever had, right? Like, why is that happening? And how do we get more people into that, right? So, I think we've done a good job of sort of creating this narrative and space and getting that heard. But I still think it's the early innings of that getting heard, because the conventional wisdom has been the opposite for so long that, we are fighting that conventional wisdom of old on the one side, and on the other, we're fighting inertia. If I didn't have a relief fund last year, then why do I need it today? Or if I didn't have a Kashable last year, why do I need it today, right? So, sometimes an event-driven impetus is good, but other times I think as we get better about educating the circuit and pointing out these things, I think we'll both do better.
Yeah, absolutely. This is kind of a little bit off the wall, but on average, how many percentage wise, how many employees are typically trying to, obtain a cashable loan
Yeah.
product, right, in
Yeah.
any given year? Is it 5% of the employee base? Is it 50% of the employee base? Is it 2% of the employee? Like, where on
Yeah.
average, where do you think that sphere
Yeah, I'd
is?
say our portfolio average is about 9-10% is our portfolio average, but there's wide variation around the mean, in the sense that, when we think about where it should be, we look at 401k borrowing rates as the right proxy, meaning if we've done a good job of educating people and the HR teams have done a good job of educating people as to which is the better long-term way to do this, then the rate of cashable borrowing should be closer to the 401k borrowing rate, and that rate should be dropping. So the 401k borrowing rate in America on average is more like 20%. So there's a large number of people, and 401k loans are long duration. So any given day, like a quarter of people that have a 401k loan in the country have a loan against it. So it's a really high rate. So there's still a markedly large number of people that are still going down that path instead of exploring alternatives like us. So we think that that delta is a delta of, how enlightened is the HR team? How sophisticated is their benefits communication strategy? Do they have a strategy? Do they,
Yep,
so
roll
are
out.
we buried in a handbook, or is there something more going on?
Which kind of bleeds into my next question. When you think about, like, if you could sit down with any CEO in the world and talk to them about their employee base, or what role they should be playing to, I'm going to say, better communities, because that's really what I believe to be true, right? If we better the employee, we better the community, whether that's through wages, whether that's through benefits, whether that's through an ability to lend a hand when you need it most, right? We have the power to do that, to do the right thing, or to be present when people need us most, to ultimately improve the world, right? What would you want to convey to a CEO or a group of CEOs about the status of the employees, the employee well-being, and what the company's role should be?
Yeah, absolutely. I think this is a very pertinent kind of point, just because there's in the CFO suite or the C-suite period. This is not so much the case in the HR suite, where the HR suite is much tighter with that average employee experience. They know and understand it well. Often the C-suite is not. Like, it's often people that had a background with great pedigree in education, always had started out with a higher income job. They've never been that average employee themselves. Like, this is the vast majority of the decision makers in the C-suite. And many times I think they feel some moral quandary when they're trying to put in programs like you or us, when they're thinking about, hey, should I get involved in my employees' finances? Like, is credit even a good thing? Or, like, is grant may trigger thoughts of welfare spending, and, like, is this the right thing, right? Like, the fact is that I think that they need to think harder about that and understand that, just like they do this in health insurance, like, when we don't look at people that have diabetes or heart disease and say, like, you must have made poor choices in how you ate. Like, that's not how we think about it. We say that, this is the circumstance of our lives. Like, this is how, like, America is set up. This is how our health system, this is how many hours a day we spend at work, and how little we have to go in the gym, and all of these other things. So this is going to be the artifact of our circumstance. The artifact is going to be that a certain percentage of our population is going to have chronic health issues, or many times they will have incidental health issues that are not chronic, and we don't look at sort of victim blaming in that space, right? And my own personal experience when we talked about the founding story is also that the same kind of situation exists with people's finances. That yes, there may be some people whose finances are poor because of profligacy, but for the most part, for a lot of people, it's a function of circumstance, and then for a lot of others, it's incidental. It's something that event driven that is happening in the macro or in their personal lives. And just like we are saying that employers are better suited to provide the safety net in health for those chronic or incidental situations, not victim blaming, is the same thing when it comes to employee finances. To be able to think about it with that same lens and say, yes, we do need to get involved. And just like with your health, you're not a specialist, you're not a doctor, and we feel like, assistance at the right time from the right specialist is valuable to you. The same thing is true of finances. The vast majority of people are poor at finances. They didn't grow up around dinner tables where their fathers were finance gurus and teaching them what to do with their money. There's a reason rich dad poor dad is a big is done as well as it has, right? Like, because all of those things are real. So given that we are in a world where there's been a very structural risk transfer to employees. Employees are responsible for more of their health expenses. They're responsible for more of their financial lives in retirement, because we're in a defined contribution world, not in a
Right.
pension world. So
Right.
much risk transfer has happened to a community that lacks the financial sophistication. Not because they're bad people. They just, like, there was no opportunity to get educated on financial sophistication. So how can we do all this risk transfer to that same community and expect them to be successful at their finances at the end of the day? It's just not fair. So because it's, such a circumstance exists, like, one kind of side effect or kind of a corollary to that is things like E4E or Kashable need to exist to be able to provide the safety net for this community that may not fully understand the financial risks that are kind of embedded in their day-to-day lives. So, that's something that's not apparent often to the CFO or C-suite overall. That's the one message that I would convey.
That's a great message, Rishi. And I don't think I shared this with you before, but my parents were high school dropouts. My mom and dad
Wow.
were 16 and pregnant with my older brother, and they lived paycheck to paycheck their entire life. And so everything that you're saying about it's a product of, like, they chose to be present as a parent than to
Right.
go and earn a high wage, right? And that has bettered our we are a close knit family. We were able to show up at little league ball games and be
Yeah.
present. Like, all that was prioritized, but we didn't have financial education. We didn't have a resource to help us take a risk potentially. Like, we
Yeah.
talk a lot about debt repayment and unexpected car repairs or medical issues, but what about also, like, buying a home
Yes.
or going into a little bit of investing or whatever your interest is, right? That
Yeah.
the freedom to do that in a, I'm going to say, a lower risk, lower cost way is empowering to an individual, right? The ability that they don't have to go work 80 hours because of a disaster last week to make up for it, right? They don't have to go further in the hole to get out of where they were 2 weeks ago is the best thing you can do for an individual. And I think highlighting those stories and talking to the C-suite about that, more often than not, you have an employee who has a situation that is, like you said, due to circumstance, not because they chose, right,
Yeah.
that outcome.
Yeah, yeah.
So
I mean, thanks for sharing that story. It's quite incredible. I mean, that you've gotten, to
Yeah.
being a CEO in a
Ah,
financial sort of space. Given that, it's incredible. Thanks to your family, parents, and you. Well, that's quite a journey.
yeah, I appreciate that, Rishi. I think we're kind of at time here, but I've really enjoyed the conversation with you today, Rishi. We love here at E4E, we love the Kashable organization and looking forward to learning more or working more with you all here in the future. Again, thank you so much. Thank you for your story. Thank you for thinking about this product, this landscape many years ago. I think what you're doing is tremendous. And can't wait to cheering you on here in the near future.
Yeah, likewise. Thank you so much for having me on. It was great to have this repartee. It's great to kind of be with a kindred spirit who is in the same space, solving the same problems. So I really love it. Thanks.